What's up, Sats fans? Welcome to another edition of Swan Signal Live. I'm your host, Sam Callahan. I'm the lead analyst at Swan Bitcoin. We have another exciting group of speakers today coming on the show. We got Joe Consorti, analyst at the Bitcoin Layer, as well as TXMC. He is the host of Alpha Beta Soup, another popular analyst on X. These two guys are great at kind of distilling down the macro picture, and it's a great time to do that because there's always a lot of uncertainty that is surrounding the macro picture today and how it impacts Bitcoin. So I can't wait to talk to these two. So without further ado, let's jump into the show. So welcome, Joe, and welcome, TXMC.
Hey guys, good to see you. Good to see you again.
Yeah, you guys. So I think this might be a little bit of a bearish show because I'm looking at your feeds and it seems like you guys both think that a recession is around the corner. Now, a lot of people are talking. They're like, "Hey, is this a soft landing? Is this a hard landing? Are we going to have no landing?" I think earlier this year, a lot of people were surprised by some of the equity moves as well as the performance of maybe Bitcoin too, despite some of the deterioration that we're seeing in the economic data. But you guys seem to think that maybe something is around the corner. So maybe let's just break down your overall views of macro right now. I'll throw it to Joe, and then we'll get TXMC's. Just an overview of your thoughts.
For sure. So once again, Sam, thanks for having us. I'll break it down, my views super simply, and then we'll throw to TX. For me, I mean, just looking at the Fed's rate hiking cycle this time around, the fastest in terms of pace and the most aggressive in terms of size of each individual hike. And so it just becomes a question to me of when, not if we see an economic slowdown, right? And the main question for a lot of people now is the severity of it. The severity and the fallout of what we eventually do see. There are people who may be in the media who are still throwing around the soft landing headlines. I have a chart. I didn't include it in the pack, but on my Twitter feed, I plot the Fed funds rate with soft landing headlines and how many of them appear in the news. And basically, one for one, every single time the Fed reaches the peak of its rate hiking cycle, there's a period where the economy is still doing fine, right? There's this transient period where like the lagged effects of rate hikes have yet to really hit the economy. They're just working through financial markets, but they haven't hit headline economic data. They haven't unwound the labor market. And so there's this transient period, typically lasts a few months to several months to maybe even a year, where the economy is doing fine. The Fed is hiked all the way up. And so soft landing headlines explode. And without fail, the Fed cuts soon after, right? And of course, the Fed only cuts in response to a severe economic slowdown, right? So to me, it's only a matter of time, right? The main question being, and TX phrased it this way: we had this big, monetary and fiscal stimulus cannon that was shot out in 2020, and so we really don't know how much cushion financial markets and by extension the real economy has. And so even though this tightening cycle has been so aggressive, this is the first time in history that we're tightening after we let this unfathomable amount of money into the system, right? So now there's this huge cushion. A lot of people, including myself, will have the recency bias of saying, well, oh my gosh, look at M2, it's contracting for the first time since the Great Depression. But by the same token, if you look at year-over-year growth during 2020 and 2021, it shot through the roof, right? And so looking at an absolute chart of M2 money supply, we're just reverting back down to the mean. So for me, it's a question of, how severe the fallout will eventually be and what is the impact of that big cushion that was left for us in 2020. The question of whether or not an economic recession will happen or not, I feel has already been answered. For me, it's a question of timing and how severe it's going to be, but I'll throw to TX there.
Yeah, I think the way you kind of put the bow on it there at the end is succinctly wraps up my view, which is that I think us incurring a recession at the end of this cycle is almost a foregone conclusion. Like it would take some kind of unfathomable miracle of some kind, economic miracle, productivity breakthrough, something like that, that would turn this ship around and negate that outcome. Because if you just kind of model the cycle and you go back, as far as we have reliable data for, which gives you about 100 years of data, there's a pretty reliable pattern and sequence to the way an economy slows down and eventually ends in a recession. And that involves both Fed policy and the economy itself, right? And, a lot of people look at the stock market and that's their gauge of how well we're doing, or that's their thermometer to decide whether these recession calls are valid or not. But the stock market is one of the worst gauges of the economy in terms of its forward-looking ability. It's usually just projecting present conditions into the future, plus some assumptions about earnings and things like that on an individual company basis. But the stock market is one of the last pieces that kind of confirms the severity of the economic finality for that cycle, which tends to end in a recession. We haven't had one in a really long time. COVID almost doesn't even really count because it was kind of an artificially driven shock. And in a lot of ways, we didn't experience the kind of what end up being virtuous outcomes of a recession, right? After the pain of people losing their jobs and businesses shutting down and things like that. Usually you move out of a period where businesses are in a much healthier place. Their balance sheets have been reset and you've gone through that rough period, right? Well, we didn't allow that to happen in 2020. We used a nuclear powered foot to kick the ball way in the air. And to Joe's point, we're kind of reverting to the mean and we don't really know how far beyond the mean we will go. Because really, when you think about, like a sine wave and you think about mean reversion doesn't mean you go above the line and then you bounce on the line. This is not mean reversion. Mean reversion is you go above the line and then you fall below it and then you come back above it and you fall below it. And that's the smaller cycles inside the larger cycles. But when we get to this point where we're at, and we can talk more about it, when we get to this point where we're at in the various metrics that you can model the economy with and the cycle, they're kind of at a point of no return, and it just becomes a matter of timing. To Joe's point about when the recession could be, and we're in. I would characterize us being somewhere in like the fifth inning of the baseball game here, where we've kind of gotten to the edge where there's almost no turning back, and it's just a matter of what are the pieces that fall into place to really make the outcome obvious to the market, and I think that's kind of what we're waiting for.
Yeah, absolutely. I mean, it seems to me that when the Fed goes on the fastest hiking cycle, or one of them in its entire history, there's going to be some kind of consequences. And I don't know if we've actually seen the extent of those consequences yet play out. And you just had like the 10-year hit the highest level since 2007. And there seems to be more fears that the Fed is not done, that they could continue to hike. I mean, we just saw the July meeting minutes kind of talk about how they're still afraid of high inflation, and the market kind of responded to those meeting minutes that they might hike longer and higher. And so what do you guys think the ramifications are of maybe yields continuing to go higher? How does it affect kind of capital flows, maybe assets that perceived as risks like Bitcoin or equities? What are some of the ramifications of yields reaching the highest level since 2007? Let me throw it to Joe.
For sure. So one of the charts that I sent you guys, it's titled tens. And that is the chart of the yields, specifically the 10-year and 10-year reals, hitting the highest level since 2007, right? And TX knows this. And for the people in the audience, the reason rates are so important, the reason the US Treasury market is so important is because it's the collateral that underpins the entire world economy. All the borrowing and lending that occurs happens off the basis of US Treasuries. And also it acts as the reference rate for basically all loans in US dollar capital markets. So, if you are taking on a 15-year mortgage, chances are you are borrowing at a spread to the underlying US Treasury rate. If you're borrowing a 30-year mortgage, chances are you're borrowing at a spread. If you're borrowing at a 10-year corporate bond, chances are you're doing it based on your creditworthiness at a spread to the 10-year US Treasury rate, right? So this multi-decade peak for the 10-year yields, ultimately, like this interest rate, this particular interest rate, the 10-year yield is so important because it dictates the entire world economy's cost of capital. Right. And it's a bit hyperbolic, but ultimately that's what it does. This is the price of money for the world. And so because of that, the highest inflation adjusted rates, the highest nominal rates, that's a stranglehold on global economic growth. And they keep grinding higher, right? So that's the first implication. And the second implication would be all of these losses on US Treasuries that banks here in the US, but also worldwide, are stomaching. For the time being, it's not really an issue because if you are a large enough bank, you can actually take your distressed treasuries and take them to the Fed and receive par in return. And so these losses on U.S. Treasuries can be erased. But what's happening? What's happening when this flood of issuance from the Treasury comes and these yields are being pushed higher? Is that the price of outstanding bonds falls? And so what has happened is yields have continued to grind higher, and the 10-year yield and reals are at their highest level in 15, 16 years, is that these outstanding treasuries get devalued, and banks are holding them on their balance sheets. And what this has caused, and I didn't send this chart, but it's caused $1.371 trillion worth of losses on U.S. Treasuries. Some of that is realized, which means those losses have been, those treasuries have been sold and that loss has been locked in. And some of them are unrealized, which means that banks are holding these severely impaired assets on their balance sheets while they're experiencing huge customer deposit outflows to go to higher rates and away from banks. And so banks are getting squeezed because all these losses are accumulating as rates are rising. And so not only does it put a stranglehold on global economic growth, but it also creates these big losses on the balance sheets of banks who are already experiencing major deposit flight amidst higher rates. So not a great picture to have rates continually soaring.
Yeah, absolutely. I mean, you described it well. It's the benchmark rate for the cost of money, kind of across the global economy, because dollar denominated debt is the majority, right? And so it does matter. It's the benchmark rate for every market, and corporate spreads, you name it. And it's definitely putting a lot of stress on, like you said, on financial institutions. They're really the ones that are feeling it at this juncture. Like mortgage rates being where they are, it impacts new home buyers, but there's a lot of existing homeowners. They're not affected by those rates. They're locked in at 3.5%. And that differential, spread differential is being released somewhere in the economy. And currently it is being released in the unrealized losses on financial institutions' balance sheets in a way, because those assets have come down in value. So I think that the Fed's in a really tough spot here because they only have a couple of tools at their disposal to do what they feel needs to be done for their mandate, which is bringing inflation down. And we could debate about whether or not inflation is really a long-term problem or not. I don't know that that's material to what the Fed is doing and what they will do, because the metrics they follow say it is a problem. But as they continue to raise rates, they are affecting, like Joe explained, with all the stress in the financial sector, but also eventually debts have to be rolled at these higher rates. Some of these losses have to actually be incurred. I mean, if you look at the corporate sector, they termed out their debt into like 2024, 2025, a couple of years ago. And really that wall is slowly approaching. And the longer that rates, the 10-year being the most important, but all of these, especially long end rates, stay elevated, that will start to play an effect in the debt markets as new refinancing needs to happen, right? They think there's a lot of different parts of the economy that have been waiting for rates to come back down and have been betting on that to happen at some point. And that really began in the summer of last year. And that timeline has been forcefully punted, 6 months out every 6 months. And, if you think back to July, September of last year, the Fed fund futures market was pricing in cuts by December. And then we got to October and they were priced in at March. And then we got to March, they were moved to July. Here we are in August. Now cuts are in early 24. And I think we get to early 24. And unless there is an obvious global recession just looming down upon us, I think that might get punted again. But that's getting really close to that maturity wall that I mentioned, where corporations will have to start refinancing at these higher rates, and that will affect their margins. That has a strong likelihood of affecting employment at that particular time. And so we're just in really dangerous territory. And then just if I could add one more piece to it, just the concept of 2% real rates on the 10-year is a threat to really all risk assets because it makes yield bearing cash in direct competition with other risk assets and their potential for return over the next coming, months, years. And so as long as we have positive real rates, you have the stress factor that Joe and I've been talking about the last few minutes, but then you also have just the market competition factor for yield. And so as long as you have rates in this vicinity, particularly as inflation continues to kind of soften on a long-term basis, then that makes competition for things like Bitcoin and growth stocks and things like that, which I know are pumping recently, but some of these effects really haven't manifested yet, and they will over time.
Yeah, the Fed is in a tough spot because if they have to fight inflation, like you said, they only have so many tools, and one of them is to keep raising interest rates. But that kind of just worsens the situation for these banks, and it also increases the yield where they can depositors at these banks can kind of turn around and say, "Hey, I'm gonna take my deposits out of this bank and go to like a money market fund." And that's kind of what we've seen. We've seen record inflows of money market funds. I think it just topped out at like $5.57 trillion of capital now is allocated to money market funds because now you can earn a higher yield. And yet the Fed is still like, "Hey, we're going to keep raising interest rates." Which could hurt the value of those bond holdings in those banks. And so we just saw the S&P downgrade a lot of U.S. banks for this reason. And you saw in the meeting minutes with the Federal Reserve that they're still worried about some of these, bond positions of these banks, and they say there's a lot of risk here. But do you guys think that the risks in the banking sector is going to come back with vengeance here? I mean, they gave out that emergency bank term funding program that's kind of patched things over for now. But it seems like the problems still are persisting. And if the Fed has to continue raising interest rates, I mean, these banks seem like they're going to come under pressure again. How do you guys feel about the situation there? Throw it to Joe.
Go ahead, Joe.
Yeah. So, ultimately, I view BTFP as a Band-Aid. It's a Band-Aid that hasn't totally been utilized yet, though. I believe there's a $1 trillion cap on the facility, or 1.5 trillion or 2 trillion, something like that, somewhere in the trillions, low trillions. But only 106.86 as of last week, $1 billion in outstanding emergency loans are being taken from BTFP. And so it's still a facility that's, it had a huge spike. Ultimately, like, banks are going there to ameliorate these losses and mend those wounds. But as the problem gets worse, I think usage of that facility is going to increase. And I think it's going to increase to such a degree that by the time the temporary facility is up next spring, I think it will become a permanent facility. Just because, like you said, the Fed's tools are limited. It's kind of trying to, maintain full employment and stable prices, which is crazy to think that a central entity could do and do well, but even crazier to try to do it with so few tools, with just QE, just these are large asset purchases from banks, and just raising and lowering reference interest rates and hoping that front end interest rates work. A lot of it relies on trust. And so when you have these really fickle tools, you're trying to carve Michelangelo's David with a pencil and a hammer that you got from Aces Hardware. They will, if a tool works, it works in staving off a crisis of confidence, as BTFP does, and I think it's going to stick around. I think there is no harm, other than allowing this risk taking to build up and continue and kicking the inevitable can down the road. I think BTFP is here to stay, just because it solves the problem it's trying to solve so well. And that problem is making sure that these banks don't have to lock in those losses, and they can meet all customer withdrawal requests, right? The last thing they want to do is a bunch of failing banks in their hands that have to be reclaimed by the FDIC and then absorbed by other banks. Ultimately, I think BTFP is here to stay. I think it's in all likelihood going to be a permanent facility, but these problems do stick around. If we think about it, like, creative destruction needs to happen, i.e. the banks that are taking large amounts of risky loans. Let's say that their banks have high concentration in commercial real estate, which many small regional banks do. They do over 70%, 71, I believe, percent of all commercial real estate lending. Yep. And then all of a sudden those loans go toxic. that bank should probably go under. But what BTFP is doing is it's allowing banks that make poor decisions to still live. And so BTFP, it works, but it proliferates these bad banking practices.
Yeah, I think for the Fed and the Treasury to eventually dig themselves out of this interest expense spiral that they've kind of kicked off with this rate battle between the Fed and inflation. You look at interest expense, it's gone parabolic, and it will continue to do that as long as Powell is getting to have his Volcker imitation. But I think for them to dig their way out of this, they're going to have to stress the financial institutions, right? They're probably going to eventually have to cancel interest rates on reserves. They're going to have to compel them to hold larger amounts of treasuries and debt securities. And those things will eventually make their way into less favorable rates for depositors and borrowers from those banks, because the banks will have to, adjust in some way. And I think that that's almost necessary, because with the amount of debt issuance that is essentially programmed into the budget over the next 30 years. Now, on the one hand, there is an immense demand for our collateral globally. And so there will be buyers of the debt. Someone will buy the debt. But there will need to be adjustments as the deficits continue to grow. Just look at the CBO projections. Those are baseline projections that expect interest expense to be double-digit percentages of GDP in the next 20 years. And that's just based on entitlement spending and unfunded obligations currently, right? It's not based on any other recessions, anything else that comes along that they think of to spend money on. That's just based on today's projections. Deficits will continue to grow. And at some point, I think a lot of people think the Fed will need to help monetize some of that. Perhaps they will. But I think along that way, additionally, that pressure will be levied upon banks and bank-like institutions, not dissimilarly to the way that war debts were gotten rid of. I think Europe did a better job of this than we did after World War II. There's a great podcast, actually, if anyone listening right now, there's a podcast on the Hidden Forces, which is Dimitri Kofinas. He just had someone named Charles Calomiris. And I think he worked at the Treasury, or he worked at the comptroller of the currency. He's a government guy, but he talked about financial repression and his idea of how it's going to play out. And I agree with a lot of what he said when it came out a week or two ago. But you should definitely check that out on Hidden Forces if you want to know more about how that could play out. And he again says kind of what I said, which is that they'll probably have to compel institutions to hold more of these securities and things in the future, and that'll make its way into deposit rates and other things. And along the way, there will be some businesses that can't handle that, right? To Joe's point, maybe some businesses go under. The BTFP facility is interesting because it has some rules around it, right? It isn't currently the way it's written. It isn't just an open well, and it doesn't have it doesn't just accept all collateral in perpetuity, right? You have to have owned these debt securities before March of 2023. So it's really geared toward institutions that owned these distressed treasuries already at the time of the creation of the facility. So there are trillions of those, and banks will continue to put those up for par in the meantime. But I think what's interesting to think about that, the BTFP, like Joe described it as a Band-Aid. I think that's the way to think about it. It's often characterized as an adrenaline shot, here, this is stealth QE. But in a sense, it's really just CPR for these distressed institutions who then have to pay back that amount of money within a year at 5%, right? So there's a net money destruction component for these borrowers. And so it is a Band-Aid. But, if you think about the way the Fed has characterized the usage of that facility, Chris Waller and John Williams, two Fed presidents in the last few months, have gone on and done interviews. John Williams did an interview with the New York Times last month where they express utmost confidence in their ability to manage any financial stresses that come up, and they cite the BTFP as an example of that. They have overwhelming, and maybe it's hubris, confidence in their ability to, handle whatever new banking stress bubbles up from the surface. They create some new facility, maybe they rewrite the rules, the BTFP a little bit, and they just move on. I like to read a lot about history, and you see this actually happen a lot. This happened during the greenbacks crisis as well, where utmost confidence was expressed in the Treasury Secretary and his ability to prevent an inflationary problem by issuing all of this extra money. And of course, that turned out not to be true whatsoever. But I just think it's funny the way history rhymes. We get into these periods of intense stress. You can also see it in 2007 and 2008. Bernanke, right? Subprime is contained. We don't foresee a recession. That was in like April of 2008. They have this blinder where they feel like they have utmost control, right? Because they sit in the highest chair of the financial system. But we've also seen that they can be very blind to obvious stresses in the system. Just look at how unprepared the San Francisco Fed was for SVB earlier this year. They didn't know that it was coming, and Powell, literally the week it happened, said we don't see any problems. So I think that they're setting themselves up to have to go further than they've expressed they'd be willing to do, and they're going to have to do more than just create some new facility. They're probably going to have to swiftly change policy if the crisis expands any more than it has.
Yeah, great points. I mean, hubris at the Fed. I mean, it should worry people. I know. I read the history as well, and they seem to be very hubristic in terms of their ability to control things, but they never seem to see it happen before it happens, right? And I was just wondering, there was a Wall Street Journal opinion piece from Jason Furman, who was a former economic advisor for Barack Obama from 2013 to 2017. And he was basically saying how, the inflation fight, they should just call victory now with the CPI sitting at 3% instead of their target of 2%. And it was retweeted by Paul Krugman, who said, yeah, we should totally just set the inflation rate at 3% now instead of 2%.
Krugman did.
Yeah, of course Krugman did. But all right, so if you could sit down with Jason and Paul, what would you say to these guys who want to, they're advocating for the inflation rate to be at 3% now instead of 2%? What would you say to these guys?
Inflation is it's one of those things. These conversations are always so difficult. Inflation is a psychological problem for consumers, right? It's a policy problem for Washington because they can choose to create or destroy inflation kind of at any point, right? But it's really a psychological problem for consumers, and I see this in a couple of ways. So in the lens of the consumer, you have people who have had negative real wage growth since April of 2021. And just recently, just in the last couple of months, by the way that we measure things and that we present it to people, just now are they actually seeing wage growth that is above the headline public inflation number for the first time since spring of 2 years ago. And so if you're going to try to convince me that a consumer that is already currently having the highest nominal wage growth that they've had in 40 years and still until 2 months ago didn't have positive real wage growth, if you're going to try to convince me that they then need to go to their boss and advocate for a 1% even higher raise going forward than they were already negotiating in the past, that is difficult for me to fathom. But also, just the psychological component of inflation is the reason why Powell thinks it's so important. It's the reason why Volcker did what he did in the 80s. Because if it gets into people's minds that inflation is going to be more of a factor than it was in the past, it affects all of their consumption and saving habits, right? It causes them to pull forward demand. So you get an impulse, maybe you see some higher growth, but it also eventually really starts to affect people's ability to save, how they think about the future, how they consider discretionary spending. And it also can really start to embed itself in the structure of yields kind of across the surface. And I know that inflation maybe isn't, a lot of people feel like maybe it's not a long-term problem. Maybe we're not in the 1970s. Maybe we are. We don't know. But there's a lot of people who feel like we're not, and that the Fed has already done too much, and that they should just go ahead and start easing now. It's clear inflation is subsiding. Why aren't they easing rates yet? And I think that psychological component is the one that they're afraid of getting away from them, for right or wrong. Right? I'm not trying to convince you the Fed's policy is the right policy, but they have a certain lens they view things through, and it's guided by what has happened in the past. And in the 70s, they let inflation expectations get away from them. It got embedded into people's habits, and as a result, it literally became runaway, and we had a wage price spiral. Those conditions are harder to replicate today, but the factor is still there, particularly when it hasn't existed for 40 years and suddenly it's something people have to contend with, and they have this memory of the 70s in their mind. It could become self-reinforcing. So I think if you're going to have this target and you're going to put the economy through what you've put it through in the last year to get to this target, and you haven't even seen it yet, and then you declare victory and raise the target, I think you're just throwing kerosene onto some latent kindling, and that's not a position that we want to put the economy in. That's not a healthy, sustainable position, in my view. Hope I answered that.
Yeah. Joe, what would you say to them?
Well, the first thing I would do is I'd ask what they were smoking, and then I would ask if I could have some or for the phone number of their dealer. No, but I mean, in all seriousness, right? Paul Krugman at this point, I think he's lost the last shred of credibility, if there even was one at the point that he said that. And this has been something that's been trotted out for years. The idea of raising the inflation target. I want to make one thing abundantly clear to viewers. And this is often a semantic thing that really goes unnoticed, but the media has conflated over the last many decades, long before me, long before all of us in this call, they've conflated inflation with prices. And so they've been able to say inflation is coming down, and the public zeitgeist thinks that prices are coming down. That's not the case. Like TXMC said, if inflation expectations matter a great deal in what the price inflation rate is going to be. If people think prices are going to go up, they're going to go out and they're going to buy now because they want to get it before prices go up, right? Which pushes prices up, right? If people think prices are going to come down, they're going to delay consumption. They're going to push consumption out because they want to buy when prices are lower. And so that's why inflation expectations matter a great deal, and why saying, let's raise the inflation target to 3% or to 4%, that already increases the problem that we have now, which is people are always in a panic. People are always in a worry that prices are going to go up, and so they go out and buy. That could throw a huge wrench into inflation expectations, which could create a whole slew of more problems for the Fed. I think, frankly, to just step away from all of it, I think inflation engineering is something that's completely dumb and completely absurd. The growth that we've had, we've become extremely productive, but there's also been a huge amount of capital misallocation. Zombie companies that simply shouldn't exist. Consumers buying for the sake of buying because real yields, inflation adjusted rates, have been negative. So in a way, you are literally losing money if you don't spend. So it's completely distorted spending behavior at the individual level, at the corporate level, even at the nation level. And so for me, I think that even though it would throw a huge wrench into the way the global economy works, and there would have to be some kind of reset, some kind of multi-year depression, then we get back on our feet. I think in the long run, you really don't want to be price inflation targeting, right? Saying prices will go up by 2% because wages haven't been able to keep that same pace. We've grown extremely productive, but wages haven't been able to keep that same pace. And so I think we need to ditch inflation targeting altogether, right? We need to reintroduce a system where growth is real growth and not just growth for the sake of borrowing because rates are below the rate of inflation. And that would increase the quality of life for everybody, right? Businesses would only invest in things that would increase productivity, not just for them, but for society at large. Individuals would only buy things they need, only invest in things that they need. We'd become more wealthy at an individual level, more wealthy at a corporate level, more wealthy at a nation state level. It'd be great for everybody. But of course, the engine of making sure prices are always going up so people continue spending. That's kind of the distorted way Keynesian economics works, right? When all of the metrics you care about boil down to spending, and your idea of growth is whether or not people are spending, that's your idea of economic activity, then the inflation targeting machine must go on, right? The 2% target must go on because it forces people to continue spend, companies to spend, and it keeps the global growth engine churning. So that's what I'd say to Mr. Paul Krugman, but of course he'd probably just ignore me and take another hit of whatever he's smoking.
Yeah, I think, let's look past the fact that the inflation rate is probably much higher, right, than 3%. I mean, it's a manipulated metric. It seems to be widely accepted now. But I feel like I need to say that. But a 3% theft or inflation target means that your dollar gets halved every 23 years rather than every 34 years in value. And to me, it's like if you have a person living paycheck to paycheck who doesn't own assets, I mean, it hurts them disproportionately when you have inflation rate higher. And I think what Joe said, where the conflation of prices and CPI, people are hearing a lot like, hey, inflation's down this year, but everything.
President Biden is tweeting it out every other day.
Yeah, exactly. Everything still feels more expensive. And you see this viral TikTok trend now of millennials and Gen Zs lamenting about their frustration about the rising cost of living, how their wages aren't going as far as they used to, and they're taking pictures of their groceries and stuff, and that's still happening right now. And yet you're hearing in the headlines how inflation's coming down, but it's important to understand that it's the rate of the price increases that have gone down, but it's still going up, right? Prices are still going up.
If I could just say about the millennials and they have a reason to be agitated as well, because they are significantly lagging behind in their quality of life wealth generation compared to where their boomer grandparents and grandparents were at this stage of their lives. So if you look at net national wealth divided by the generations, and you look at when boomers were in their 40s, they had significantly more than where the millennials are that are now entering about age 40. I'll be 40 soon, and I'm a millennial. Millennials are at about 35% of the level of net national wealth that boomers were at about 30 years ago, 25 years ago. And that is a significant drag. The boomers still have all the wealth, even though the number of millennial households is almost the same as the number of boomer households now. And so there's a massive transfer that I think people, you hear about this wealth transfer concept that I've been hearing different people talking about in the last few months that will happen over the coming years. I think since the Fourth Turning is Here book came out, people have been talking about it more. But that process, there is a significant amount of purchasing power that is laying with a cohort of the population that has a low propensity to spend, and they are not the people who drive GDP. We on this call are the people who drive GDP, right? We're the people who will be creating new households, having children, putting those kids through college, buying cars and homes, going on vacations, and making the most of our money. That's the people who should be the ones driving GDP, and also the ones that wealth should be accruing to. But there's been kind of something has clogged that channel, and I think that what ends up pushing that wealth, I guess, no other word to use it, those assets into the hands of the younger generations, I don't think that process is going to be very elegant. It's going to be a mix of inheritances, death, and government helicopter money, right? It's going to disperse these things out. And I think that it makes sense that when you consider those factors, you consider this inflation conversation that we're having, when you consider that the 5-year rolling change of real GDP in dollar terms peaked in 2000, 23 years ago, the 5-year sum of GDP. So the amount of inflation adjusted dollars that we add to national income on a 5-year basis peaked in the tech bubble. And so when you think about all of those things, it makes sense that we have a rise of populist politics. We have a rise of social malaise, a lack of trust in institutions, and just people generally not feeling great about their future prospects and just kind of wanting to spend and live in the now, right? You see that in polls and a lot of this soft data that's coming out, people not really thinking about saving for retirement. They're more interested in their experiences and having vacations and things like that. And I think it's because they see the rails that their parents and their grandparents use and that they were told that they are supposed to use. And those rails don't really look very reliable, and they don't look like they go to a good place. And so I think people are casting about for new answers, for new solutions. Yeah. And you see that in both the politics and just kind of the sentiment of the times. You see it everywhere.
Yeah. 1/3 of Gen Zs have saved zero for retirement. And that number is about 23% for millennials.
And there's a huge explosion in sports betting as well. And in lieu of saving for retirement, I'll tell you that the rise of DraftKings, the rise of all of these other apps is the alternative. People my age see no other way out other than essentially gambling.
YOLO.
I'll have people text me on the weekends. I watch a lot of MMA, and people will text me who've never watched a UFC event in their life and say, "Hey, who should I pick tonight?" So people may not even be involved in the sport. Just like when people used to, your dad may bet on horses, right? He may go down to the horse track and bet on a horse, not because he watches horses, but because he needs to make some money. And people are increasingly resorting to, Sam, as you said, YOLOing it rather than saving for retirement because they see no other way out.
Yeah, it's this financial nihilism that people talk about. Just whatever, my situation's not great long term, might as well throw this bet on and maybe, just maybe, I'll hit it big. It's sad, and then I think there's a conflation with Bitcoin. People think it is this get rich quick scheme, but in reality, young people, if you look out at other asset classes and how inflated they've gotten, and then you can look at Bitcoin and the opportunity there because it's still such a small asset. And the youth have a lot of time on their hands, so they can benefit from the ongoing adoption of Bitcoin and the subsequent price appreciation. So when I look at Bitcoin and young people, I really think it's a match made in heaven, because if you're going to retire, you're not going to touch those funds for a long time, and you can allow Bitcoin to do its thing, and perhaps it could help them actually get enough wealth to retire one day. Because right now, I think a lot of them are pretty hopeless. But I wanted to turn to Bitcoin because, we had a kind of a chaotic week. The volatility came back with full force. It woke up from its summer slumber. It dropped back down to towards 25,000. And there's a lot of speculation as to why that is. One of those things is Binance. And Joe, I know you have a chart. I was wondering if we could throw it up here on the screen to kind of walk people through it. But some people think that this could be some selling going on behalf of Binance. Can you talk us through what's maybe going on there? And then I'd love to hear TXMC's thoughts about maybe what are some of the catalysts of maybe this recent price movements. But let's throw up this chart here, Joe. You can walk us through it.
Phenomenal. Yeah, so there's been a long rumored, so I'll start off with this. Binance is obviously the largest crypto exchange in the world. And to get to that size, for any company to do it without taking on any debt whatsoever, that's a bit of a stretch, right? It's a bit of a stretch that you were able to do that. And that's what Binance has claimed. They've claimed that they do not have any debt. They haven't taken on any debt, and they presently do not have any debt outstanding. And that's, in my view, again, that's total BS. And you take that further to what Binance has been known to do. They've been discovered to be doing some of these fraudulent behaviors, including rehypothecating customers' funds without their knowledge. So removing coins from customers' wallets, using them for other purposes before slyly putting them back in. They've done this with Bitcoin, they've done this with BNB, and they've done this with USDT. And so you take it to its logical conclusion. Okay, they've said that they have no leverage, yet they are the largest crypto exchange. Okay, so we'll say that that's BS, right? Using our prefrontal cortex. And Binance Coin, right, which is essentially an equivalent of a common stock in the Binance company, was issued, right? This is they own a large share of this. Okay, so if this is their largest asset and they have leverage, chances are they've collateralized a lot of that borrowing with BNB. It's not a stretch to assume that. And so if BNB, right, like any other company, is common stock and Binance borrowed against it, just like any other company does with the amount of equity that they have outstanding, right? just like any other company, then they have a vested interest in making sure that Binance Coin's price does not dip below a certain level. Now, you see this level here defended, held pretty steady through all these years, through 2021. You saw very, very small bounce there on this line, like the 200 to 220 level, roughly speaking. Yep. And then it bounced again last June. And of course, it is miraculously bounced up off of this level over several months earlier this year. And now in June, it has tested that level several times and not broken through. And so if you think about it, who is the only player in town that has a vested interest in making sure the price of BNB is supported? It's Binance, right? If they have loans collateralized against BNB, their common stock, then obviously there is a level at which those loans get called in if the value of the collateral drops too much. And given the unusual defense of this 220 level, I'll ask you this. With real rates the highest they have been in 15 years, and I actually put a chart on my Twitter, it's the 10-year real yield and crypto failures. And crypto, these various crypto frauds, these schemes, these coins, they've unwound as real rates are now approaching 2%. Okay. So with all of that happening, with this global de-risking, this $5.57 trillion in U.S. money market funds, $40 billion of inflows last week, the S&P 500 is finally turning as the risk premium just isn't there anymore for owning the S&P 500, right? If all of this de-risking is happening, who is buying Binance Coin, right? Who is divesting? Who is taking on Binance Coin, right? Who is divesting from these other instruments and going to Binance Coin? It's Binance. In my view, there is no other player in town.
Yeah, I mean, it makes a lot of sense. And Binance has gone through a lot of issues with regulators. They've been sued by the CFTC, the SEC. There's a slew of senior officials who left from Binance. They've been cut off from fiat rails. And so it's pretty weird that their coin continues to kind of hover above that level. And that's why there's a lot of speculation around, could there be some kind of loan that they're trying to prevent from liquidation so that that doesn't tank? Because we know that Binance holds a substantial amount of BNB on its balance sheet. So TXMC, I don't know if you have thoughts around this Binance stuff or just this price drop in general, but I'd love to finish off with just a thoughts from you on this, and then we can close up this talk.
Sure. Well, I don't have a strong opinion about what's going on with Binance there. I think Joe's probably more on the money with anything than I could come up with. But I do think the BNB chart is probably one of the most interesting things to look at in crypto right now, because it's literally hovering over the ground like Luke's land speeder. And I think that it's a pretty quick trip to $50 if that level gets lost. I mean, just look at the chart. It's basically held up by a flagpole. And if that goes, then there's going to be a lot of people wrecked in this space, because they're the biggest exchange. They currently have the biggest spotlight. They have a lot of Bitcoin. They also have a lot of BNB. But I think it's Binance FUD is definitely an appealing topic. I don't know how much fruit is on the vine. Like, they definitely have SEC lawsuits and they're up to some suspicious stuff. But then there's also like maybe another like 30% that's just people kind of throwing things on top. And sometimes, it's hard to know what's true and what isn't. I know that as far as like on-chain activity goes, it can be really hard to know who's actually up to certain things if you haven't gotten all the addresses tagged just right. But yeah, I don't really I don't have a view on the concept of the collateralized loan thing, but I think I'm watching the chart closely, and if it starts to break down, then I think a lot of the space is in trouble.
Gotcha. Well, I can't thank you guys enough for coming on Swan Signal and sharing your insights. You guys are both great follows on Twitter. So, I believe, Joe, you're just at Joe Consorti. Is that correct?
Yep.
And then TXMC Trades, and you can find his YouTube channel too, which is extremely popular. So thanks so much for coming on the show, guys. I really appreciate it. I always talk to you guys around, so I'm sure I'll see you in Spaces or somewhere else. You guys are welcome back anytime. Really appreciate you guys.
Yeah, absolutely.
Thanks for having me
out with you guys. TX, long time no speak. Same thing with Sam. And great chat, boys. Have a good rest of your week.
Yeah, I'll see you in BitBox Boom if you guys are going to be there.
It's great. Thanks for having me on, guys. Good talking to you both, and we'll do it again.
All right, and thank you. And before we go, I just want to throw a shout out to Pacific Bitcoin. That's a conference that Swan puts out October 5th and 6th in Santa Monica. You can check it out below at promo code Signal for 21% off your tickets today. Pacific Bitcoin, some of the greatest speakers in Bitcoin are going to be there, educators. We got a mining panel set up. It's going to be an excellent event in Santa Monica. Last year it was beautiful there. So October 5th and 6th, check it out, pacificbitcoin.com. And you can get 21% off today by using the promo code Signal. So thanks for listening, guys. We got a lot of great shows lined up. We got Neil Howe from the Fourth Turning. We got Lynn Alden coming back on in a couple weeks. So we'll be continuing to bring you the signal here on this show. And thank you so much for being a loyal listener. So like, comment, and subscribe to this channel, and really appreciate your support. So thank you very much. Signing out right now. Thank you.